Good morning, everybody. Great to see so many of you join the call, and please do start posting your questions to the Q&A, and we'll make sure that we get through all of them if we can, and if not, we'll certainly come back to you afterwards as well. So as Neil said, we'll just spend the next half an hour or so giving you a bit of a narrative of where we've come from over the last 6 months, but also where we think we're going, and to give you a sense of the direction of travel in the market as well. It's a very fluid market. There's a lot going on, irrespective of tailwinds, headwinds in the macro and geopolitical. We're in a sector that is continuing to grow incredibly quickly, but also has huge structural opportunities ahead of it over the next few years. So we continue to be pretty busy in the market in terms of assessing opportunities and working with our portfolio companies, and hopefully you'll get a better flavor of the direction of travel after this call. So in terms of where we are, as Neil would have said, that the NAV has largely remained flat. What that doesn't reflect is significant underlying growth in the portfolio. Of course, we all recognize there's been a lot of focus on valuation and multiple contraction, and that's really been kind of reflected in the flat NAV, despite some very significant kind of underlying growth in the portfolio. For us at the moment, what is equally important has been the ability to exit some portfolio companies and to ensure we sit on a strong balance sheet. So we have no leverage in the trust at all. We are sitting on a good amount of cash. That cash isn't burning a hole in our pocket, but at the same time, we want to be reflective and cognizant of the market conditions and valuation out there. And we'll talk a little bit about pipeline, why we haven't deployed as freely as we have in the past, and why we think the next year and beyond could be really compelling vintages, and why we do want to be armed with a good amount of cash over the coming 12 months to be able to kind of capitalize on what we think are some pretty exciting opportunities. Now, my job isn't to be a macro commentator, but just wanted to highlight this orange line here. Now, we're focused on privates. This is orange line is the global listed fintech index, so the basket of listed fintechs in the market. And I think what's interesting here is really that the market, the global listed fintech market, hasn't recovered yet. It's pretty much bumping along the bottom. We think it's been pretty indiscriminate. We think there's some very high quality listed fintech assets that haven't been re-rated, and we'd argue we're one of them. But at the same time, there has been a pretty kind of significant de-rating in the market over the past 18 months or so. We would expect that to see a recovery in parts where some of those high quality companies are really kind of putting strong runs on the board. Where are we now in terms of our portfolio? So no additions since many of you will have last seen. I know we have many Augmentum holders on the call, but also some that have been following the story for some time. We haven't added any new companies in the last 6 months. What we have now is a really well-diversified portfolio across those subsectors within financial services where we've had real conviction. What will change over time, of course, are the relative percentages here through exits, through opportunities in other areas. The one addition over the past 12 months has been a kind of our first foray into the insurance sector. We backed a business in Germany, looking to build out and capitalize on what we think is this very significant emerging trend in cyber insurance, which is increasingly becoming more specialist, and we feel they're well positioned to be able to kind of capitalize on that. A very experienced team that have already had one significant exit in the insurance space. One area over the past 2 or 3 years where we've been really looking to build capability within the team and deepen our domain expertise has been on the kind of payments and also the infrastructure space, the B2B space, where we're seeing a lot of capital and focus being applied. And that's an area where we continue to spend a lot of time and effort. And if we look at our pipeline, there's a fair amount there. I would say to the right side, you would see more B2C propositions, which perhaps are a little bit out of fashion, but also we think really present a quite interesting opportunity as well as customer acquisition costs come down, where marketing expenditure isn't as free as it was. And so if you do have the right proposition, we think you can build quite an interesting B2C proposition on a fraction of the cost that perhaps it was going to cost 2 or 3 years ago, where there was a significant amount of, frankly, too much marketing and money being deployed in the B2C space. So what is the measure of progress or performance of ultimate success for this trust? And yes, of course, share price performance is really important and something we're focusing on very heavily in terms of reducing that discount, but also the proof is in the pudding of realizations. So you will have seen a steady growth in NAV through growth of the underlying portfolio as alongside issuance, but also for us to be a top quartile, top decile in particular venture fund, we need to be kind of hovering north of around 20%. So our internal target is to be delivering that over the long term. You will have seen that kind of drop down in the past kind of 12 months. As I said, that has been as a result of kind of the multiple contractions rather than the strong underlying performance, but still kind of tracking around where we would like to be over the longer term. And if you look at the exits that we've had, the aggregated IRR has been north of 50%. So, of course, you have winners, you have losers in your venture portfolio. Ultimately, for us, when we look at this over the next 5 years, we would expect that to be high teens, low 20s, and that really would put us as one of the outlier performers and hopefully something that we can continue to demonstrate through a continued flow of exits over time. So what have we been doing? Well, we haven't been deploying as much capital as we have in the past, and I would say that has been quite deliberate. Yes, of course, there's a significant amount of opportunity in the market. I would define the year that has almost passed as a year of two halves, or to be more accurate, a year of 3 quarters and 1 quarter, where the first 3 quarters were low in what we would regard as overall quality. There was a flight to quality for those businesses where we had high conviction. We saw pricing still pretty aggressively high, and we weren't prepared to trade at those prices. We always talk about good companies not being always good investments, and I think the entry price is incredibly important. I think if we reflect over the last 5 years, one area where we've got a lot more conviction and refinement and data is on exits and how these businesses might be exited if they deliver on their expectations. And so we're very, very focused on what that means in terms of getting the right entry price and also being rewarded for the risk that we're taking. So the capital that we have deployed has really been into the existing portfolio where we have really strong conviction. The winners, you've got to kind of continue to back your winners in your portfolio. That will drive the ultimate return. We have a business, very high growth business in Vault in the open banking orchestration payment space. A very large US fund came in earlier in the year, and we wanted to ensure we weren't going to be diluted in that investment. So we followed in particular into that. Since post-period end, we've also invested further in another one of our big winners in Tide, where there was an opportunity to take some secondary from early investors that were really in need of liquidity, one in particular, a fund that was winding up. And so ourselves alongside others took that opportunity to pick up some stock at what we thought was a really good kind of a value trade. Ultimately for us, and we'll talk a little bit about exits along the way, we want to continue on the ride for those businesses where we feel have a significant amount of upside to go. We can talk about the journey that we went on with Interactive Investor, where we had multiple opportunities to exit along the way, but we continued buying. So at 500 million, 700 million, 900 million, there were all opportunities to exit, and we took each one of those to buy more stock, and obviously ultimately exited at 1.5 billion. But at the same time, we'll look at every exit opportunity very objectively and dispassionately as well. And we did that with Cushion when NatWest came in somewhat surprisingly earlier in the year, much earlier than we would have anticipated exiting that business. We only held it for 18 months, but we felt it represented good value and was the right moment, even though we still have conviction on the pension space for a variety of reasons. Some detail which probably not appropriate to go into now. We felt that was the time to take that return along the way. So I really want to kind of also highlight the discount, the opportunity. Neil touched on it earlier, but I think it's really important to bring it to life as to what that actually means. And this was at as of October 31st, so it represents the actual cash position, the market cap at that time, which has ticked up. So at that point, when you strip out the cash, you've got an implied portfolio value of 95 million. That's called at 100 million in round terms. So what does that actually mean? Well, when you look at the 24 portfolio companies, and even if we just take the top 5, even if you took the top 3, that exceeds the implied portfolio value. So arguably you're getting 21 assets for free. Even if you look at the top 5, that was trading at a 39% discount to the implied value, and the top 10 was at a 53% discount. So we think there's extraordinary value. We have strong conviction in some of those assets that we think can continue to deliver some strong growth and ultimately an exit well north of the holding value now. But let's just dwell on that top 5, and if you're just putting that in the mix and saying, okay, if your implied portfolio value is around 100 million, here's the fair value of 150 million. Well, what's really under the hood? How are those top 5 assets in terms of NAV actually performing? And you can see that overall growing really strongly. Are they richly valued? Well, no, not at all. And I think we've always, in our view, erred on the side of conservative when it comes to valuation. These are businesses, when we apply the forward revenue multiple, have got a blended average of 4.8 times. Some of them are kind of remain in that what we regard as our early, mid, high growth. But even some of our more established businesses have continued to grow really well. And you can see here the level of growth that these businesses have seen in their time since we've invested as well. And equally important is we're starting to really see that path to profitability come to fruition. So 2 years ago, I would say a lot of these businesses were high potential, high growth, but the questions being posed by investors was, that's all well and good, but are these businesses ever going to be profitable? And I think the answer that I would have given, and I still give to many of our residual portfolio companies, is we are in many respects not about optimizing for profitability while they're continuing to grow their market, steal market share, and there is a significant opportunity ahead of them. In many cases, I would far rather the business lost $1 million than made $1 million, if that £2 million net was investing in that next phase of growth. And I think the scrutiny that the market in general has put on these high growth businesses is, growth is all well and good, but is it profitable growth? Is it sustainable? What are the underlying unit economics? What are the KPIs? Can these businesses get to profitability? If they need to be profitable, can they immediately flick a switch in a market where cash isn't as plentiful as it was 2 years ago? And I would say, many of them have shifted to profitability. Tides, Opa, Bullion Vault, all businesses that have demonstrated that. Vault still very much on that high growth journey, raised a very significant amount of capital, so has a long runway of cash ahead of it. And Grover, which has really gone from what we regard as that kind of mid Series B to that more established growth business, and now very much pushing on that path to profitability, ensuring gross margin continues to improve, ensuring it's got runway in terms of a path to profitability, and really demonstrating that its underlying unit economics are really strong. So how does that business get viewed? What are the KPIs when it exits, either at IPO or through a trade or private equity sale? What are they going to be looking for in order to kind of maximize that exit? And we're really kind of focused on that, not just now, but have been over the past 12 and 18 months that we've seen. So when we look at the overall portfolio, the question that I probably get asked more often than not is, it's all well and good in a market when you're trading in a discount. It's great that you're sitting on an amount of cash, but what we don't want to see are 24 assets that are going to spend 10 years to get to maturity. It's important that we have a path to visibility on what the exit horizon looks like. And so you can see here, yes, the number of companies in the portfolio are weighted towards the early and the mid. So they're on a journey to still on high growth, still on a path to maturity. Not all of them will flow through to be, success stories, but ultimately we need to make sure a few of them, can become those outlier success stories. However, we need to be able to kind of have time for those businesses to prove themselves and to be able to continue to invest in their growth stories. So we need to ensure that we have enough companies in that later stage where we have visibility on exit over the next kind of 1 to 3 years. And I think we've got a well-balanced portfolio where I think we do have a good amount of visibility of what's coming down the pipe. Businesses in many respects that are really strategic in their nature, where yes, everybody points towards IPO as a route of exit. The reality is in fintech in particular, there are a very significant amount of strategic buyers. So if you aggregate all the exits in fintech over the past 6 or 7 years, 95% or so of those exits have been through M&A, either by strategics or private equity. So that is the most likely route for exit by some way, and I think that is a reflection of the very significant strategic nature of this asset class, but also reflective of some of the challenges that the incumbents have as well. And we'll talk a little bit about that later on as well. This is a hard slide to go into detail and for people to scrutinize, but one for you to really kind of look at the ups and downs. And I think what's important here is this is a portfolio that is approached from a valuation point of view on a 6-monthly basis. It doesn't necessarily need to have independent rounds for it to be going up and down, but ultimately the vast majority of the portfolio is being valued through public market comparables, through that basket, to counter the view that venture and private equity isn't accurately reflecting the public markets valuations, where there is a historic lag in private market valuations. We really do believe that our portfolio is very much reflective of the public market conditions, and I guess that accusation can't be leveled at us in a sense that we are not portraying what is happening in those public markets. And I think this is a great way of showing it, and something which we've shared over the last couple of years to show you what happened. And this is the high growth listed fintech index, and you can see in the listed markets quite the multiple that was used back in 21, where we saw unprecedented forward revenue multiples of 23 times forward revenue. So if we go back over the last 20 years and you kind of overlaid the global SaaS index as well, you would have seen somewhere between 7 and 9, that range. And I think that's a reasonable proxy to use. Yes, that's kind of come down considerably, and you'll remember the chart I showed at the beginning showing that the listed fintech index is at that low at the moment. We don't go all the way back to 19 when that chart. I think the really important message that I want to leave you with is that at the height of the market, you can see the delta between where the listed fintech index and where the Augmentum top 10 forward revenue was. So we have hovered between 4.5 and 6 over the last 3 years, which again hopefully does reflect the approach that we've taken to valuation. And when we talk about growth, and I think growth is kind of an important feature in this. I was asked on an investor call just before, if we look at the global SaaS index, if we look at the global listed fintech index, what has been that growth rate over the past 12 months? Well, we can't give a definitive view because we don't have the data for every one of those businesses, but we would indicate it's somewhere between -5 and 20%. So if you go back to our top 5, which was growing on average at 100%, and our top 10, which on average is mid-70s, you can see these are businesses growing at a multiple of what these listed businesses have been growing at, and yet are trading at a discount to those forward revenue multiples. So hopefully another kind of data point to say that we are erring on the side of caution there. We're not valuing these businesses at what we hope to exit them for in 2 or 3 years' time, but really at what we think we could exit them today. But when we talk about exits, as I alluded to a little bit earlier, if you look at our track record to date, so 5 exits, 84 million of realizations on just under 200 million of capital deployed, the average uplift to the net asset value for each of those assets has been 30%. So ultimately, what we need to continue to demonstrate is that when we are exiting assets, we're exiting them at our holding value, or ideally, well north of that as well. And I said the track record so far is very strong in that regard in the 5 that we've exited. And, hopefully we can continue to put more runs on the board, which will only kind of increase, hopefully, the conviction and confidence of investors that they can have real confidence and comfort in the underlying valuations that we have. So a little bit more on the approach to valuation. And if I went back 3 or 4 years to the portfolio, you would have seen a much bigger bar for the price of recent transaction. And again, that has been an area of real scrutiny in the private equity and venture capital space over the last 12 to 18 months, where the criticism in many respects, fair criticism, that it's all well and good raising around in the absolute height of the market, but the market has moved on over the last 2 years, and to be holding it at that arguably inflated value, if you did raise money at those prices, wasn't reflective of what's going on in the market. And if you look at the Augmentum underlying approach to valuation, and you look across the portfolio, actually the vast majority, and this is much bigger than the 69%, because I'll talk about liquidation preference in a moment, but really we'd say it's about 90% of the portfolio is reflective of public market comparables, a basket of comparables, unless there's been a very recent independently priced round in the portfolio. So what do we mean by liquidation preference? Well, some of you understand it incredibly well, but others might not be familiar with the downside risk that we as a venture investor and as an early investor put in most of our structures. So we would put two key terms. We'd ask for the preference share. So in a scenario, I'll give you a very simple example. We invest 5 million in a business that raises at a 20 million valuation. We would have a 20% share in that business with a post-money valuation of 25 million. That business goes on a journey over the next 2 to 3 years. It doesn't, unfortunately, do what we thought it would do, but it has built some IP. It could be a technology-led business, or it could be something else, and we sell that business for 5 million. We, as the last money in, would get all of our money out. So we take our money out. So despite the fact that there's been an 80% drop in the valuation, as the preferred shareholder, we would get all our money out. Alongside that, in that same situation, that business goes to raise more money. It raises a 10 million valuation. Our anti-dilution would kick in, where we would be issued more shares to compensate us for the dilution that we've suffered as a result of a down round. And again, that's an important feature. Now, of course, it doesn't always guarantee that you get your money back, because businesses in venture can fail and ultimately they can be worth zero. But ultimately, we have used that to our advantage when we sold assets that have frankly been underperforming, but there was value in that preference, and we've been able to take our money out specifically as a result of our share class relative to ordinary shareholders. So yes, we're very much a glass half full. We're looking to back very ambitious projects that sometimes take many years and a fair bit of capital to get to their full potential. But at the same time, we do want to protect our downside where we can, because I come back to the point that we are backing a lot of businesses where they are very strategic, and there often is a real residual value, even in those scenarios that don't turn out quite as we hope. So direction of travel, quickly, in terms of where we are. I mean, this is the current top 10, which, as I said, accounts for about 82% of the NAV. What's really important here is not just the growth, but also the runway, because we are all aware that capital is not flowing as freely as it was 2 years ago. It's important that these businesses that are still growing recognize that they're not going to be to raise as easily as they have done in the past, and they need to make sure that they are managing their capital accordingly, and the metrics that they're demonstrating are very much reflective of what the market is looking for to further invest in those businesses. So that runway has really extended over the past 2 years. If I'd shown you this slide 2 years ago, that runway would have been in the low teens, probably 14 or 15. So making sure that we've got extended runway alongside that growth, and balancing both that growth and runway alongside those that have really shifted to profitability, which has been very encouraging to see. So just before I wrap up, just the last kind of 5 minutes on what are we seeing in the market, where are we, what can we expect to see over the next 12 months? Well, we're back to where we were, I would say, in 18, 19. You can think 20, we all know, was an anomaly year for the wrong reasons with COVID. And then really the second half of 20 and 21 were extraordinary years where capital just came flooding into the tech market, in particular in the fintech market, where we saw investors come at a level we'd never seen before. We saw new entrants to the market that have since disappeared, and we call that tourist capital. We don't think that's unfair, because we think these investors that came in really distorted the market, giving too much capital to too many companies at the wrong price. In particular, at the later stage, not the stage where we would typically invest. But if you look at the average funding rounds, you can see literally it's reverted very comfortably back to the mean of 18 and 19. So that's where we see the market. The market then in 18, that was a record year. And I don't think we'll be too far off. We've kind of got 9 months of data here. We don't think we'll be too far off the somewhere in between 18 and 19. So it's still a strong market. There's still capital in the market. There's still a lot of smart investors, but a lot of that irrational behavior has been removed from the market, which we think is a very healthy thing, and we're very happy to see it. But the structural opportunity remains. There is a huge market opportunity in this space. Over the next 5 to 6 years, the market today is probably around 300 billion, we would estimate, in what fintechs are generating in revenue. That grows, in our view, 5x over the next 5 years. So we are going to see hundreds of businesses built on a global scale in the fintech space worth, billions of dollars that don't exist today or do exist today in a very small way. So there is a very significant market opportunity ahead of us. Yes, the market from a perception and sentiment point of view can wane and wax in terms of valuations, but fundamentally how you should think about this asset class is there is a long way to go and there is a significant amount of opportunity, and that's why we think we're incredibly well positioned to capitalize on it. And, again, why aren't the incumbents taking advantage? Well, they're investing a massive amount of money. We know they've got big balance sheets. We know they're investing hundreds of billions of dollars a year in R&D, in digital transformation. Unfortunately for them, they are facing some very significant headwinds and challenges with their legacy infrastructure. A lot of that capital isn't used or deployed effectively. It's not delivering on the significant transformation hope that they've had. And as such, they are increasingly becoming very significant customers of fintechs, or B2B fintechs in particular, and of course are very significant acquirers. And we've benefited from that over the past 18 months with the likes of NatWest and Aberdeen acquiring our portfolio companies. And so we'll continue to back businesses that help service the incumbents and help stop them being disrupted to the extent that they are being, but also we'll back businesses that attack them head on, and arguably they could become acquirers down the line, albeit we have many businesses that feel that they have a good opportunity to IPO, but ultimately I come back to the data point of before that 95% of fintechs do ultimately get acquired, and that's something to keep an eye on. So what about pipeline? Well, the pipeline is strong, as I would say, in Q4. We look at a lot of things. We have a very significant database. We have a very kind of well-run CRM system. We continually have what we would define as our watch list and our priority watch list. And the team is exceptionally busy building relationships 1 or 2 years before these businesses are ready, from our point of view, to be investable. But it's important to kind of build that conviction to make sure you're meeting as many of these talented fintech teams as possible, so you can start to kind of build those relationships and be preemptive as and when the opportunity arises. Now, that conversion rate is incredibly low. It's lower than it has been historically, and that has been as a result of our reflection on what we think, where the market is going and where it has come from, where we are sitting on our hands as and when we have conviction in the business, but not in the structure. So we're still very insistent on making sure we have our downside protections, but also on making sure that the entry price is right. And I'd say, where we have got it wrong, when we have got it wrong on entry price valuation, that has been because the expectation on the exit has been perhaps a little bit optimistic of how are these businesses going to be valued on the way out. And I think we are, frankly, much more sophisticated, and we have many more data points today than we did 5 years ago on how these businesses will be valued on exit. And I think that really does give us a lot of pause for thought on the way in, that we've got to try and get that entry structure, that entry price right, so we are rewarded for the risk that we're taking. And that's an area where we continue to kind of really hone in on. Just to give you a sense of what we're looking at, it's still a really broad number of areas, and the 23 where we went into deep due diligence. So yes, we look at hundreds of businesses, but ultimately when you're going into what we regard as deep due diligence, that's when you're spending several weeks in the business. You're spending several weeks referencing the team, the proposition, customers, etc., in the market. But we do remain very much a thesis-led team. We have a number of themes where we have kind of deep conviction, similar to what we saw with Baobab, which we've been tracking that industry for about 18 months, waiting to see when the European market would be ready to start to develop. We're still at the early stages of that, and so that's a business that is at the start of the journey. And I think there are 3 or 4 businesses in Europe trying to really build out and become that world-class kind of cyber insurer platform, and hopefully Baobab will be one of the winners that breaks through. And just finally on dry powder, we talk about it a lot. The industry talks about it a lot. Of course, a lot of that dry powder isn't drawn down, but what you should be looking for is what was raised, in particular in 21 and 22, which is starting to be deployed and has been deployed in the market. In the historic norm for VC funds and PE funds would be to deploy over a 3 to 4 period. Second half of 20 and 21 and first quarter of 22, we saw these funds being deployed at an unprecedented pace. So 12, 18 months, ridiculously quick. At the same time, there's still a lot of capital that wasn't deployed, and we're going to see that continue to flow through to the market. So even if you look at this, dry powder available in the market, the estimate is still, on a global level, there's $500 billion in there. So the market remains competitive. It remains competitive with funds that we think are frankly more sensible. There are very few specialist fintech funds out there, which we think gives us a real competitive advantage as well. We have a very experienced team that have been in and around the market a long time, not just as investors, but also as operators and entrepreneurs. So we have built and sold from scratch businesses where we've operated at multi-billion-dollar valuations, but also the last decade collectively we've been investing as well. So I think we bring a pretty it's not quite unique because there are obviously other operators and entrepreneurs that have become investors, but not many in the European VC scene. And we think that does stand us out and give us that differentiation alongside the fintech specialism. So Neil, I'm going to pause there, 31 minutes on the clock. So I will open to questions. So if anybody wants to add now to the Q&A, if they felt they want a bit more color, then I will stop sharing my screen, and Neil, you can have a look at the questions and let me know.
No, that's lovely. No, I really appreciate the update there. That's very useful. Thank you for the introduction to this. And we've got a few questions here ready to go through, but as Tim said, do add to the list if pertinent to do so. But I'll start off with the first one. I think we talked about 24 companies within the portfolio, and a question here on how many companies actually the team could handle before more resource is actually needed. Do you have a view on that?
So there isn't a prescriptive answer. I mean, I would say we would think typically for a team of our size, 30 companies is probably about the right number. So yeah, we've certainly got capacity. We're pretty active in our portfolio companies, so you would expect us to take a board seat or a board observer seat. And that's really important because you, one, have to have oversight, but two, you need to have influence, in particular at the early stage. Of course, the dream is these businesses all become established, well-run. You bring in professional boards and you can step off, which we've seen in the likes of Interactive Investor and Zopa and the like. But, on their journey to what we regard as, just before exit, there is a lot that needs to be done. So yes, there is overhead. This isn't a strategy where you can back 60, 70 businesses and close your eyes and hope and wait for the best, because we've got a lot of experience. There's a lot of pattern recognition across the portfolio, and we have the benefit of, I guess the four senior members of the team. It's 100 years of market experience, both as entrepreneurs, operators, and investors. And I think that's really important to lend some of that knowledge and experience, the good and the bad, to the portfolio. And we see, the problems and the challenges that our portfolio companies have are very common. And you can see the future often, what's coming, and you've got to be preemptive. And I think it's our job to do that, to provide advice and sometimes make difficult decisions, changing out, senior team members, sometimes founders moving on. And over the years, we've done that. It's a very difficult thing often to do, but it's a very important thing. And I think more often than not, if you make sure you bring in the right professional management team at that point in which perhaps a founding management team or a founder in particular has hit their limit, then the rewards are there. And we always say to our founders, you need to think about this as a shareholder, not as an employee. And we've had a lot of really positive experiences in that regard as well. So no, I mean, answering that question, there is capacity, and we've got a bit of room to go.
No, that's useful color. Thank you very much for that. The next question is about cash management strategy, and has your cash management strategy been able to exploit the higher interest rate environment that we're now in?
So is that how are we managing our cash?
I think it is.
Yeah.
I think whether there are any advantages basically from that environment for you.
Well, I mean, we recognize the question about cash drag, of course. We also want to make sure we invest our capital smartly, and we want to be armed for what we think is going to be quite an exciting 18 to 24 months ahead. So yes, we're sitting on more cash than we would normally do. You're quite limited in what you can do with that cash. So putting it in the overnight money markets, earning 5% at the moment with JP Morgan. Of course, we're doing that, but we need to be able to kind of access it at a moment's notice as well. So I hope I've answered that. Victor, do type another question if there was another. If there was another.
Well, on that point, there is another one actually.
Okay.
I think there's a question on whether you could provide details on the losses in the portfolio. I think it's 6.9 million under other investments, and whether it was all due to Gemini and I'm going to pronounce this incorrectly.
Provides. No, I mean, actually, there's that chart that showed you kind of the ups and downs. You see the specifics on the top 10. There are some greens and there are some reds, so you can kind of eyeball those, and of course the aggregated numbers. So yeah, I think it's a mix of those two and others as well. It doesn't mean that there's been down rounds. In fact, neither of those there isn't. It's just, again, it's applying public market comparables or looking at market conditions and seeing what's happened and valuing accordingly. Or we might sit there and say that the business isn't performing to the extent that we think it is. Even if we valued it at liquidation preference, which would be 20% of its market value, we still don't think that's prudent enough. It's got X amount of cash on the balance sheet and our share is Y, and we'll value it at that. So I think, every case is different. Of course, auditors and valuation committee at the board will scrutinize that. So yeah, it is a bit of a mix, but hopefully you can eyeball some of that on that chart as well. I'm sure some of it's in the interim report as well.
Great, thank you. And we've got a couple of questions on share buybacks, but sort of to wrap it into the one question, I guess, is to note that how extensive the discount is at this particular stage, given the NAV is about 160, and the company has bought back shares, quite a lot of shares in the past. But the question is what now, and whether the view of the company in regard to buybacks has changed at all.
So I guess buybacks is very much the domain of the board, the PLC board, and I'm the manager. So I can't opine as to what they will or won't do. Clearly, in 22, as a percentage of our cap table, I think we're one of the most active buyers of shares. I think maybe 5-6% of the stock was bought back. I think from my point of view, I totally get the maths. It's usually accretive. That's unarguable. Of course, the reason to do it is one, show solidarity in the NAV, and two, to use some of your cash if you can't, better use it, and three, to try and close the discount. As we know, the market's been pretty indiscriminate. There's been lots of scrutiny on buybacks, and I think we can certainly argue that we were certainly ahead of that scrutiny. As the manager, my view is now I want to be growing the trust. So of course, the flip side of buybacks is you're shrinking the size of the trust, and I think we can be much bigger. And two, you want to make sure that you're in a position of strength with your cash position, where you can capitalize on what's ahead, where investors are confident that you can support and follow on into your existing portfolio, as well as kind of invest in new companies. as I said at the beginning of the call, the good news is we don't have any leverage, so there's none of that to be concerned about. And I'm quite happy to be, armed and ready for what's ahead. In a scenario where I didn't feel that we could deploy that capital effectively, then I guess I would, feed back that to the PLC board. So, yeah, I mean, I think there's always a good case for both. It's something that does come up a lot. There's a lot of, Neil, you would have heard a lot of it in the market. As I said, we were very active, but at the same time, I feel the next 12 to 18 months, I want to be prepared and ready to be able to capitalize on what's ahead. So I'm quite happy to be well capitalized as I am.
Yeah, indeed. And just to sort of, not to labor the point, but just to add a sort of final remark from my side, where I think the evidence in the wider listed fund market, particularly in the sort of private equity space, has been that, share buybacks have taken place, but preservation of balance sheet strength is one area that has been a particular focus for many boards of directors. And I think it was Pantheon recently that sort of experienced that actually doing quite a large buyback in some ways also, doesn't actually contract the discount. But thank you, Tim, for your answer. We've had a little bit of a rally in the question front, and we can only probably take a couple more, but I'll just work my way down. Tim, recent headlines commented on an advisor and wealth management CIO suggesting that retail investors lack appropriate structure to access private markets with regard to long-term asset funds. Is it frustrating to hear that when closed-ended companies, arguably the best structure for permanent capital, have been around for multiple decades, allowing access to private markets? And what can be done about this lack of awareness among some professional investors as well as retail investors?
I read those comments, as I'm sure many people did, and somewhat bemused at them, and equally frustrated. I think there is a lot going on. I guess the likes of the AIC are trying to kind of promote the benefits of investment trusts and accessing the ability to access private assets. Retail ownership of investment trusts has gone up significantly over the last few years. I think some of that messaging is landing. We have quite a lot of retail in the trust. We've been quite active in that, very actively promoting to the likes of Interactive Investor and AJ Bell and Hargreaves Lansdown, speaking to their teams both on the content side and trying to just be as engaged as we can be. You see the likes of Primary Bid as well, trying to kind of open up access. So yeah, I think it's something which we've always felt this was a phenomenal opportunity for retail investors to give them that diversified exposure to an asset class that's very hard to access. And hopefully from a team that is sifting through a huge amount of noise and identifying those, one or two needles in the haystack. So I was pretty surprised at those comments, but I do think there's a lot going on. And I think the data will show you that, retail engagement and ownership of investment trusts has gone up considerably over the last few years. And it's something we really recognize as really important for us as a trust as well. And so we do probably spend a disproportionate amount of time engaging with the retail sector. Indeed.
There's a couple of questions on the fintech VC space, so I'll try and wrap them into one. And I guess the first one is in regard to what your view is on the biggest risk in the VC space is at the moment. But if I can also add on to that, how your support network has developed since your days at Rothschild, and whether it's been enhanced or if you can comment on that at all as well, that'd be very helpful.
Biggest risk facing, look, there isn't a single biggest risk. There's lots of different answers depending on the sector that you're focused on. Availability of capital, regulatory risk is clearly always an issue facing the market, but it does very much depend on where you're focusing. I would say if you look at the last 12 months, the biggest risk beyond regulatory risk has been capital runway, hence why the market has not seen as many companies kind of come through. And so have we seen the bubble burst? I think I go back to the slide I showed on terms of the market opportunity, that there is still a lot of enthusiasm for the sector, but I think people are being more selective. I think the lens has improved. As I said, I think the quality of investors who remain in this market is much higher. A lot of that kind of tourist money has left, and so hopefully the quality will rise to the top. So yeah, I mean, if you ask me for a single answer, I always would say for certain segments of the market, regulatory risk is an issue, but at the same time, it presents a real opportunity as well for many businesses. And we've seen in the UK in particular, in some respects, quite a progressive approach to regulation, albeit there are always kind of frustrations that it doesn't move quickly enough because innovation is always ahead of regulation. And so I think that's the balancing act, and we've seen those headwinds in certainly the digital asset space in the US in particular. In terms of how has the fundraising and support network for fintech investing developed since we were backed by RAT? Look, I think the market has just become more and more established. I mean, it goes through waves. There's clearly more capital now than there was 10 years ago, which is great. I think there are more proof points in the market. I think the IPO market is a source of frustration, not just for the fintech space, but for the tech space in general. And we all know that there are a lot of structural changes coming into the London market. I don't think structural changes solves all the problems. I think we've got a demand issue, but that's for another time. But yeah, look, I think we've got a really strong ecosystem, in particular in London. We're a European investor, and we've been very active on the continent over the past couple of years as we kind of build out our capability and brand in France, Germany, Sweden, etc. But London is still very much the center of gravity for fintech, for capital raising, for exits, and we don't see that changing in the next 5 or 6 years either, to be honest.
Great, thank you. I'll take this as the final question for today's session, if I may. We've talked a little bit about how conservative the valuations are for Augmentum and its portfolio, but do you think exuberant assessments of valuation in other parts of the market have detrimentally affected sentiment in the sector at all?
Oh, 100%. Yeah, I think that's right. I mean, I think in a market that we've been experiencing over the past kind of couple of years, in many respects, you benefited from the exuberance when everybody was glass half full or brimming to the top. And then when the market turned, then the same sentiment kind of remains, albeit on the flip side. And as I said earlier, it's indiscriminate. And what many haven't done is kind of go under the hood. And again, the reason we talk so much about valuation is because that is one of the biggest single criticisms, of the space, to say, look, there's a lot of, there's a lot of euphoria, but why haven't you written down your valuations to the extent that we've seen in the public markets? And all you can do is, well, we didn't write them up. So I think we have suffered from that. I hope because we can give more transparency, investors start to feel confident that actually there's a real justification to how we've been valuing and the approach that we've had. And of course, the exits, what you want to have is deliver more and more exits and people feel more confident in your underlying valuations. So I get it. I think the one thing that investors always want is more information. I totally understand that because, and I see Victor's asked another question of they want more detail on the rest of the portfolio. The reality is that we're backing private companies, and our competition isn't the listed markets. Our competition is traditional VC funds structured as GPLP structures, where there is no disclosure of information other than to LPs. And so we're trying to walk the tightrope of trying to share information about our underlying portfolio versus not giving away too much information, which prejudices them, gives their competition data that they'd rather not give, and frankly allows our competition to say, you see those Augmentum team, they give away far more information than we do. That's why you don't want to take their money. So I think, that is a challenge, and it's something we're really conscious of. And so we do walk that tightrope. So in an ideal world, we'd absolutely open the books and give everybody all the data that they could possibly want. But these aren't public companies. These move very quickly as well. These are very fast growing companies in many respects. And actually being private and being able to kind of grow under the hood is a huge competitive advantage to them, and one which we're kind of cognizant of. So, it's a hard tightrope to walk. And as I said, we work with our portfolio because we always say, can you give us more? But there are often good reasons why they don't.
Great. Thanks very much, Tim. And I can see we're getting towards the time where I think I'd quite like to pull up stumps. We're heading towards the lunch bell ringing at 12 o'clock. So, Tim, thank you so much for your time today and the useful update on the fund. A couple of summary points, I guess, just to finish off with that I pulled from this. The valuation was not marked up in the good times. So the 160.2 NAV, is felt to be very conservatively marked. The team have kept their strong pricing discipline in 2023, kept their balance sheet strength throughout, as Fintech has remained derated, should we say, from the market and tech generally. And the share price has been way off the pace. And we note the top 3 positions alone, plus cash in the portfolio, accounts for more than the total market cap of the fund. So the option value here is enormous. And the financial sector is going to continue to see huge disruption in the coming years. And this fund, under the stewardship of Tim and his team, is very well positioned to be the leading beneficiary of that trend for its shareholders. So I would urge you to look at this fund if you're thinking about a bit of sensible risk in a really interesting sector as we head into 2024. The ticker is AUGM for Matthew, LN, and is available to purchase through the company's brokers, Peel Hunt and Singer Capital Markets. Thank you very much, everybody, for today. Look forward to seeing you next time.
Thank you.